All right, welcome. Today, we're going to break down the very first steps into the world of stock trading. So if you've heard about people making money in the markets, but you're just not sure where to even start, well, this one's for you.
You know, so many people hear stories about these huge, fast profits, and they start to think that trading is some kind of get-rich-quick scheme. But let's just reframe that idea right from the get-go.
And this is maybe the most important mindset shift you can make. See, successful trading really isn't about hitting the jackpot. The real goal here is to stop taking like a gambler who's looking for that one big win and start thinking about systematic, steady growth on top of your long-term investments.
So you might be asking, well, why should I even consider trading if it's not about becoming a millionaire overnight? And the answer, really, lies in one of the most powerful forces in all of finance: compounding. We're going to look at how trading can be a tool to seriously accelerate your wealth creation.
So let's just imagine for a second you invest 2 lakh rupees. Now, getting a 15% annual return is a fantastic result for any passive investor, right? And over 20 years, that grows to an amazing 4 crore rupees. But what if trading could help you boost that return? What if you could aim to double that annual rate?
And this is where it gets really powerful. See, doubling the return from 15% to 30% doesn't just double your money, oh no. Because of the magic of compounding, it multiplies it exponentially to a staggering 47 crore rupees. That is the real goal, using disciplined trading to boost your long-term growth.
Okay, so now that we kind of get the why, let's dig into the what. I mean, what even is trading at its most basic level?
You know, it's just like a merchant who buys t-shirts for, say, 50 rupees and then sells them for 200. A trader does the same thing with stocks, hoping their value will go up. It's a really simple business principle. But the stock market has this unique, powerful advantage you just don't find anywhere else.
In pretty much any other business, you have to actually own something before you can sell it. But in trading, you can make a profit even when the market is going down. It's called short selling. It's kind of like you borrow a stock, sell it immediately at a high price, and then, hopefully, buy it back later at a lower price to return it. That price difference? That's your profit.
So how do you actually put this into practice? Well, when you go to place a trade, you basically have 2 main paths you can take, and they have very different rules, different risks, and different requirements. And this table here really breaks it down for us. Delivery is probably what you think of when you hear investing. You buy the shares, you own them, and you can hold on to them for years if you want. Intraday, on the other hand, is all about the short term. Every position you open, whether it's a buy or a sell, has to be closed out on the very same day. Just notice the key differences in the capital you need and that ability to sell first.
Okay, so you probably spotted that intraday trading requires much less capital, and that's all thanks to a really powerful but also pretty risky concept called leverage.
So, to put it simply, for intraday trades only, your broker basically lets you control a big position with just a small amount of your own money. It's designed to amplify your potential returns from those small daily price moves. Let's see what that actually looks like.
Let's just say you've got 5,000 rupees in your account that you're ready and willing to trade with.
So for an intraday trade, your broker might offer you 5 times or 5x leverage on that capital.
And just like that, your 5,000 rupees now has the trading power of 25,000 rupees. That means you can buy or sell 5 times as many shares as you could with just your own cash. Now that sounds great, but there is a massive catch that you absolutely have to understand. And this right here is the most important thing to remember. Leverage, it's a double-edged sword. It magnifies everything. Your profits are calculated on that full 25,000, but so are your losses. A tiny move against you can wipe out your starting capital incredibly fast. You have to handle this tool with extreme care.
Okay, so now that we understand the ideas of intraday, delivery, and leverage, how do we actually place a trade safely? Well, it all comes down to managing your risk, and you do that by setting clear rules for yourself before you ever click that buy or sell button.
Here are 3 non-negotiable rules for managing your risk. First, instead of a market order that just buys at whatever the current price is, you want to use a limit order to set the exact price you're willing to pay. Second, a stop loss is your safety net. It automatically gets you out of a trade if the price moves against you by a certain amount you decide beforehand. And finally, the golden rule: never, ever, ever trade with money you can't afford to lose.
So, as you can see, the basic tools of trading, they're actually pretty straightforward. The real challenge isn't about understanding the tools, it's about mastering your own psychology. The biggest takeaway here is that successful trading doesn't start with a hot tip. It starts with realistic expectations, a solid grasp of the concepts, and above all, a really disciplined approach to managing your risk.